Hi, welcome to Numerix video blog. I'm your host, Jim Jockle. Joining me today, FX expert and vice president in the business development group, Udi Sela. Udi, how are you, sir?
Very well, thank you, Jim.
Udi, just back from Global Derivatives in Barcelona last week. Just want to get some of your thoughts. And arguably, for those not familiar with the Global Derivatives Conference, it's kind of like the Paris Air Show, but just for quads. So, Udi, give us some of your top-line thoughts of some of the big trends that you're seeing this year from Global Derivatives.
Yes, Jim. So the main thing is really about the increasing importance of technology and its impact also on the quantitative work. We've seen and heard speeches and presentations about big data, about artificial intelligence and machine learning. And then, of course, the big question that came up was in terms of numerical methods, do we really need to invest in this now that the available technology today enables you to perform brute force calculations on almost any quantitative problem? So why do I need to look for shortcuts?
So, Udi, you mentioned AI, and it's interesting that AI is now at what has been such a traditional kind of show, looking at new model adjustments and new methods. But arguably anybody with an if-then statement has an AI solution nowadays. So in terms of practical uses for AI and machine learning, what do you think we're actually going to start seeing on the trading desk in the next few years?
So I can tell you two direct examples that I heard that already are taking place. So one is using artificial intelligence for model calibration in real time, or almost real time. And the second thing, which is, you can argue, maybe it's sad, but it's the reality, is the fact that you can use supercomputers today, feed them with financial regulation, and the machine will interpret for you the measures that you need to take. I heard that one of the banks, without naming, actually let go over 200 lawyers because this could be done, the work could be replaced by machines at arguably a lower cost.
Well,
There's all the implications, right?
Well, automation is rife, and try and find a retailer to buy a nice suit. You have to go online, and I think it's going to be the same. Definitely continuing a trend in quantitative finance and in capital markets. But one question that I have is, we always talk about learning from the past and utilizing historical evidence to program and dive into this machine learning universe. And there's been so many benchmarks that have happened, whether it's the New York City default in the muni market in the 1970s, or elements of the latest crash. How is this historical data sets, now that we have so much more data, tons and tons of data that's multiplying so rapidly, how does this change or help to evolve elements of the capital markets? Because it really seems like fundamental thinking could be on the way out.
So two things I would say, Jim, in that respect. First of all, as you mentioned, one thing is having the big data, but then the second thing is how can I derive from it, more intelligent decision making, and in fact, how can I also manage my book better? So now I can look at all those massive data points, but I can also look for correlations and relationship between the data points, the things that people never looked before. So if beforehand I was looking, let's say, the relationship between the equity market or specific indices, let's say in the currency markets. Now I can look at many more. I can tie them to macroeconomical factors, and I can derive very interesting relationships that based on the past that may help me better manage my book and position my book for the future. And people of course mention the black swan, right? So the black swan events tend to happen when there is when the market trades with high level. We always say it's between greed and fear. So now the fear levels are low and the greed levels are high. And you can see that at the current level of the VIX, which is just hovering around 10. So I would say that, this is a good timing to think about things, because a black swan event can happen around the corner when you see just different things that happened even just last year.
Would you expect, and you bring up the VIX, and yes, I think we're almost at a 10-year low right now, sitting around 10. I mean, back crisis, I think we spoke. There was a spike up to 60. At this point in time, would you expect greater volatility within the index?
Yes, I think that, if you like, look at the elasticity of the VIX, it seems much more reasonable to see an uptick move than a downtick move. So to move, let's say, from 10 to 8.5 requires much more than moving from 10 to 14, if you like. Yes, absolutely.
And that volatility, how is that going to impact spending and investment? Obviously, at any point in time, markets are down, trading profits are still kind of thin across the board. Is how much is the VIX going to be an indicator of technology investment and innovation?
So, I mean, the VIX is just one symptom, right? It's a symptom of the fact that really the fear in the market is in low levels, right? So one thing is that, I mean, you've touched on a couple of things in your question. One thing is about, trading revenues flat, right? So how can I generate more trading revenues when, as a bank, at least, or let's say we're talking about the sell side, I need also to comply with more and more regulation. So one thing is, I think, is automation. So moving a little bit away from humans, market making at least, to and more into algo trading. And I think another trend that it will impact is to move to the cloud. I think it's undeniable. Biggest institutions now moving to the cloud, including JP Morgan that announced that, even to the public cloud. We see our clients talking about that, and that will also imply managed services. And for firms like ourselves, this is an opportunity.
Well, Udi, I want to thank you so much. I think it's clearly a new dawn in terms of quantitative finance and the way the markets are going to be working in the next couple of years. And I think your statement on the cloud, it's we always kind of said it's not if, it's when, and I think the when is now. So, Udi, I want to thank you so much for your perspective on global derivatives, and of course, we hope to see you soon.